While you're watching this video, someone has just retired with £2.3 million in their retirement pot. And someone just retired with £47,000. Both worked for 40 years, both had similar salaries, and both followed conventional financial advice. The difference? One simple decision at the age of 25. In the next 18 minutes, I'm going to show you exactly what that decision was. And more importantly, exactly how you can make that decision, even if you're starting late. By the end of this video, you'll know your exact retirement number. You'll know if you're on track or if you're falling behind. And if you are behind, you'll know exactly how you can catch up. But here is what's going to shock you. The average person watching this video is £847,000 short of their retirement goal, and they have no idea. Let's start with a brutal reality that the UK government don't want you to understand. In 2025, the full state pension is £230.25 per week. That's £11,973 per year. Now, according to the PLSA, the average person in the UK will need £31,700 for a moderate lifestyle retirement. Even at a moderate level, you're over £19,000 short every single year. And what's more scary is that gap has to be filled by you and your savings. Here's where it gets terrifying. The latest FCA data shows the average pension pot for people over 55 is just £107,300 at a safe withdrawal rate of 4%. That gives you £4,292 per year. That's £358 per month. Combined with the state pension, you're looking at £16,265 total income in retirement. But you need £31,700 for a moderate lifestyle. You're getting £16,265. You're over £15,000 short every year. Over a 25-year retirement plan, that is over £385,000 short. But before I show you how to fix this crisis, let me ask you something. What if I told you that the biggest retirement enemy wasn't inflation, market crashes, or even low wages? It's something much more dangerous, and it's happening to you right now. I want to tell you about Sarah and David, both primary school teachers. Same school, same salary, same expenses. But their retirement stories couldn't be more different. Sarah started at 25, earning £28,000 per year. Nothing special about her salary, but Sarah made one decision that changed everything. She started investing £200 per month into a simple FTSE 100 index fund. Just £200 per month. That is less than what most people spend on takeaways within a month. For 32 years, Sarah never missed a payment. Her total contribution was over £76,800. But here is where it gets interesting. At the FTSE 100's historical gain of 6.3% per annum, her portfolio grew to £847,000 by the age of 57. Sarah retired at 57 with nearly £850,000. Using the 4% withdrawal rule, that gives her over £33,880 per year, plus her state pension of £11,973. That means her total retirement income is over £45,000 per annum. She's living more comfortable in retirement than she ever did in employment. Now meet David. Same salary, same expenses, same school. But David, he waited until 35 before he started investing. He thought, I'll just invest more and I'll catch up. So he started with £400 per month. This is double what Sarah invested just 10 years later. David invested for 32 years until the age of 67. His total contributions was £153,600. This is exactly double the amount that Sarah invested. But his final portfolio value, only £358,000. Even though he invested twice the amount that Sarah did, he ended up with half the amount that Sarah did. That 10-year head start that Sarah had was worth £489,000. That is the power of compound interest. Time in the market beats timing the market every single day. And it definitely beats contributing more money later on in your life. Now here is where it gets really interesting. I'm about to show you someone who earned less money in their salary than both Sarah and David, but retired with more wealth than both Sarah and David combined. Meet Emma. She worked in London in finance, earning £65,000 a year. Sounds good, right? But she was spending £55,000 a year in lifestyle and just to live in London. Rent, transport, expensive lunches, dining out, after work drinks. The London lifestyle was eating her alive financially. After all expenses, Emma was only saving £10,000 per year. At 30, Emma made a radical decision. She moved to Newcastle and accepted a £45,000 per year job and cut her living expenses to £25,000 per year. Suddenly, she could invest £20,000 per year instead of £10,000 per year. Here's the math that is going to shock you. In London, investing £10,000 per annum for 25 years at 6.3% per annum would have given her £544,000 per year. The Newcastle plan? Investing £20,000 per year, a staggering £1,088,000. She literally doubled her entire retirement wealth by earning £20,000 less per year. But here's the kicker. Emma's quality of life dramatically improved. No more 2-hour commutes, no more £15 lunch salads, no more cramped flat shares. She bought a house, enjoyed her garden, and actually enjoyed her work because she wasn't stressed about money. Stop. Before we go any further, I want to address the elephant in the room. You're probably thinking, that all sounds great, but I don't have £500 per month to invest. You're crazy. Well, if I told you that's exactly what the wealthy want you to think. Because while you're making excuses, they're using a completely different handbook. Now let me tell you about James. He was 45 when he had his financial wake-up call. Divorced with £15,000 in credit card debt and exactly £3,200 in his pension. His friends were all talking about retirement, and James realised he was financially behind them by decades. Most people would have just given up, but James did something different. He got aggressive about his finances, but smart about his strategy. Firstly, he consolidated his debt and created a payment plan. Then he moved to a smaller flat, lowering his monthly costs by £400 per month. He sold his car and started using public transport and saved himself another £300 per month. He meal prepped and saved a further £200 from not eating out or dining. Within 18 months, James had cleared his debt, and now he was in a position to be investing £900 per month. From age 47 to 67, he invested every month consistently. His final portfolio value was £312,000. Not enough to retire early, but enough to retire comfortably at age 67, with a total income of over £24,400 per annum. The lesson? It's never too late to start, but you have to be willing to make real changes. James sacrificed for 5 years to make 20 years of comfortable retirement. But here's what nobody tells you about why most people fail at this. It's not about the maths. It's about the psychology, and our brains are literally wired to work against us. Here's what the financial industry doesn't want you to understand. Retirement planning isn't really about math. It's about psychology. We have something that is called present bias. Our brains value immediate rewards much more highly than future rewards. £100 today feels more valuable than £200 in a year. even though mathematically we all know it isn't. Then there's the social comparison. We see friends buying new cars, taking expensive holidays and upgrading their homes. We feel the pressure to keep up with them, but here's the secret the wealthy know. They're not trying to impress anybody. They're building assets while everybody around them is building liabilities. Let me rewire your brain for wealth building. Instead of thinking I can't afford to invest that £500 per month, think I cannot afford not to invest that £500 per month. And here is a crazy stat for you. Every £500 that you don't invest at 30 costs you £5,427 at 65. That expensive holiday that you're thinking about, it's not just costing you £3,000 today, it's costing you over £32,562 in retirement. Suddenly that holiday doesn't seem like a good value. Now let me show you the advanced strategy that sophisticated investors use but rarely share. It's called the 3-bucket system. Bucket 1 is your sleep well at night money. 6 to 12 months of monthly expenses in cash or government bonds. It's not there to grow, it's there for emergencies and for peace of mind. Remember, this is psychology. Bucket 2 is your steady growth money. 60 to 70% of your money should go into index funds. Think S&P 500 index, think FTSE 100 index, or even FTSE All World index funds. This provides steady and long-term growth. Bucket 3 is your swing for the fences money. 10 to 20% of your portfolio that you can afford to lose. Individual stocks, emerging markets, whatever you believe has got high growth value. And here's something your financial advisor will never tell you. The retirement industry is built on a lie. They want you to believe that you need millions to retire comfortably. But what if you could cut your retirement number by £200,000 with one decision? A change that actually improves your life starting today. We're almost done, but this last part is super crucial. But everything I've shown you means nothing if you're going to make these 3 mistakes I'm going to reveal. Mistake number 1, ignoring inflation. At just 3% annual inflation, your purchase power is literally halving every 23 years. That comfortable retirement income level becomes poverty over time. Mistake number 2, sequence of return risk. If the market crashes early in your retirement, you may never recover. This is why the 4% withdrawal rule exists. Mistake number 3, ignoring long-term care costs. The average care of a UK care home is £600 to £1,000 per week. That's over £31,000 to £50,000 per year. A few years in care can wipe out a lifetime of savings. But here's the solution that most people are missing. If you cut your expenses from £40,000 to £35,000 per year, your target portfolio size drops from over £1 million down to £875,000. That saves you £125,000 that you do not need to accumulate. And that can cut years off of your working life. Here's your exact plan. Step 1, we're going to calculate your retirement number today. Take your desired retirement income and multiply this by 25. Ultimately, that's going to be your target portfolio size. Step 2, open a stocks and shares ISA this week. You can use someone like Hargreaves Lansdown. Start with a simple FTSE 100 index fund. Then set up a direct debit for whatever amount that you can afford. Just make sure it's consistent and every single month. Step 3, increase your contribution every year. For example, if you get a pay rise, use that pay rise to invest more into your ISA. When you pay off your debts, redirect those payments to investments. Help get that compound going. Step 4, diversify your portfolio as it grows. Add international bonds, REITs, different ETFs. But keep it simple until you have at least £50,000 invested. Step 5 is all about protecting your wealth. Have adequate insurance and make sure that you have enough money for your emergency fund. Remember, 6 to 12 months of expenses stored away in a current account or a savings account. And most importantly, don't panic during market turndowns. Step 6 is all about optimizing your lifestyle to make sure that wealth building is at the forefront of your agenda. Find ways to earn more money and spend less. That's the simple point. Consider geographic arbitrage if possible. So for example, living in Asia with low outgoings and costings for your living, but you're on a European salary, for example, in the UK, you'll find that your savings will increase a lot quicker and can go a long way into your investment portfolio, even if you're only doing it for 3 to 5 years. And most importantly, try to develop side incomes. We all have skills, utilize them, list them on Fiverr.com, go out on Freelancer and start earning a side income. You can retire 10 years earlier, even on an average income. It's not just possible, it is math. Sarah retired at 57 with over £847,000. Emma simply doubled her wealth by earning less. And James has recovered from financial disaster. They all use the same principles that I have taught you in this video. The only question is, will you apply them to your life? You now have the roadmap to bridge that gap to a comfortable retirement. Don't let your future self down. If you've enjoyed this video about how to retire 10 years early, then make sure we hit that like, hit that subscribe, and get in the comments with what you would like me to cover next to improve your financial outlook.